Imagine it's March 2009. You're Kevin, 44 years old, a regional sales manager for a mid-sized manufacturing company in Columbus, Ohio. You have a mortgage you took out in 2004, fixed rate, nothing exotic, the kind your father would have approved of. You have a 401k that has just lost 38% of its value in 7 months. You have 2 kids in middle school and a wife who works part-time at a dental practice that is itself losing patients because people are deferring non-essential care when they are not sure if their job will exist next quarter. You are not underwater on your house. You are not in foreclosure. You are not among the worst cases, and you know it. But you are scared in a way you have never been scared before, not the sharp fear of an immediate crisis, but the slow, ambient fear of a man watching a system he trusted reveal itself as something other than what he was told it was. Then, over the following months, something shifts. The Federal Reserve cuts rates to near zero, Congress passes a stimulus package, the Treasury backstops the banks. The stock market, which bottomed in March 2009, begins to recover. By 2010, Kevin's 401k is climbing again. By 2013, it has fully recovered. By 2019, it has more than doubled from its pre-crisis peak. Kevin exhales. The system worked. The adults were in the room. The tools did what they were supposed to do. He files this experience under crisis survived and moves on. What Kevin does not know, what almost nobody told him, is that the recovery he just lived through was not a healing. It was a loan. Every tool used to pull the economy back from the edge in 2009 was borrowed from the future. And the bill for that borrowing has been accumulating with interest ever since. The next time the system cracks, Kevin will be 60 years old. The tools that saved him last time will be either exhausted or severely diminished, and the crack will be wider. This is history meets economics. And history, it turns out, has a very dark sense of humor about this. If this is your first time here, hit subscribe and turn on notifications. Here is the question I want you to sit with before we go further. Do you genuinely believe the global financial system is more stable today than it was in 2007? Or are we just further from the last crisis than we are from the next one? Put your answer below. I read every single comment. Most people think the 2008 financial crisis was solved. The banks were saved, the recession ended, growth returned, stock markets recovered. The official narrative goes, yes, it was bad, possibly the worst since the Great Depression, but the policymakers responded decisively. The system held, and the reforms that followed Dodd-Frank, higher capital requirements, stress tests made the financial system safer than it was before. Crisis as teacher. Lesson learned. System upgraded. This narrative is not entirely wrong. The immediate crisis was resolved. The banks did not collapse. The depression that was possible did not arrive. If you measure success as avoided the worst, then 2008 to 2010 was a policy success. But there is a different question, one that the official narrative does not ask. What did the rescue cost, and what did it do to the system's ability to rescue itself next time? Because the tools deployed in 2008 were not free. They were not neutral. They changed the structure of the financial system in ways that have been compounding ever since. And every crisis since the European sovereign debt crisis of 2011 and 2012, the repo market seizure of September 2019, the pandemic shock of March 2020 has required a larger, faster, more aggressive intervention than the one before it. The doses have been getting bigger. The patient has not been getting healthier. To understand why, you need to understand what the rescue actually consisted of, not the politics of it, the mechanics. When the Federal Reserve cuts interest rates to near zero and holds them there for years, it is doing something specific. It is making borrowing cheap and making saving unrewarding. This is the intended effect. Cheap borrowing encourages spending, investment, and risk-taking. It reflates the economy. What it also does, inescapably, is encourage the accumulation of debt at every level, household, corporate, and sovereign, and inflate the prices of assets like stocks and real estate, because when safe assets yield nothing, money flows into anything that might yield something. This is not a side effect. It is the mechanism. The economy is stimulated because debt increases and asset prices rise. But the debt does not disappear when the stimulus ends. It remains on balance sheets, household, corporate, governmental, as a permanent legacy of the recovery. The asset prices do not quietly retreat. They are politically and financially embedded. Millions of retirement accounts, pension funds, and bank balance sheets depend on them staying elevated. So the economy recovers. But it recovers on a higher base of debt and a more inflated set of asset prices than it had before the crisis. which means the next crisis will hit a system that is already more leveraged, already more dependent on assets staying elevated, and already more sensitive to any disruption in the flow of cheap credit. The history here is not recent. It is a pattern that has been building for decades, and the evidence accumulates across continents. In Japan, the asset bubble of the 1980s collapsed in 1990. The Nikkei fell from nearly 39,000 in December 1989 to under 15,000 by 1992. Real estate prices in major cities fell by 60 to 80% over the following decade. The Bank of Japan responded with interest rate cuts, government stimulus packages, and eventually quantitative easing, the purchase of government bonds with newly created money, a tool so unconventional at the time that it had no real precedent in modern central banking. It worked, in the sense that Japan did not experience a 1930s-style collapse. It did not work in the sense that Japan spent the following 3 decades in a state of stagnation, economists eventually named Japanification, permanently low growth, permanently low inflation, permanently near zero interest rates, and government debt that rose from roughly 60% of GDP in 1990 to over 260% by 2023. Each stimulus package borrowed more headroom from the future. Each round of easing made the next round harder to avoid. Japan did not solve its crisis. It extended it across 30 years and paid for the extension by mortgaging the balance sheet of an entire generation. In the United States, the pattern has compressed itself into shorter cycles. The savings and loan crisis of the late 1980s was resolved partly through low interest rates that helped banks recapitalize by borrowing cheap and lending dear. Those low rates contributed to the conditions for the dot-com bubble of the late 1990s. When that bubble burst in 2000 and 2001, and then September 11th delivered a second shock, the Federal Reserve under Alan Greenspan cut rates aggressively, taking the federal funds rate from 6.5% in 2000 to 1% by 2003, and held them low for an extended period. Those low rates flowed directly into the housing market, fueling the credit expansion that became the subprime crisis of 2007 and 2008. The medicine prescribed for one crisis became the cause of the next one. This is not speculation. Ben Bernanke, who chaired the Federal Reserve during the 2008 crisis, has acknowledged in his own published work that prolonged low interest rates in the early 2000s contributed to the housing bubble. The institution that created the problem also led the rescue from it. You will forgive the raised eyebrow. Then came 2020. In March of that year, financial markets experienced one of the fastest collapses in recorded history. The S&P 500 fell 34% in 33 days. The Treasury market, the deepest, most liquid financial market on earth, briefly seized. The Federal Reserve responded within days with an intervention that dwarfed everything that had come before. It cut rates to zero. It launched unlimited quantitative easing. It created facilities to purchase corporate bonds, including junk bonds, for the first time in its history. The Federal Reserve's balance sheet, which had taken over a century to reach $900 billion in 2008, expanded from $4 trillion in February 2020 to nearly $9 trillion by early 2022. In less than 2 years, it added more to its balance sheet than it had accumulated in its entire prior existence. The economy recovered, asset prices recovered, and then inflation arrived the fastest in 4 decades, which forced the Federal Reserve to raise interest rates at the steepest pace since the early 1980s. Which in turn triggered the collapse of Silicon Valley Bank in March 2023, when the bonds it had purchased at low yields became worth significantly less in a higher rate environment, which required the Federal Deposit Insurance Corporation and the Treasury to intervene with emergency guarantees to prevent a wider bank run. Crisis, rescue, new fragility, new crisis. The cycle continues. The interventions grow larger, the subsequent vulnerabilities grow correspondingly. The mechanism is this. Every financial rescue has a cost that does not appear on the rescue's balance sheet. It appears on the next crisis's balance sheet. When rates are cut to zero and held there for years, 2 things happen simultaneously. First, debt accumulates because cheap money is borrowed and spent and stays on balance sheets as an obligation that must be serviced. Second, the economy becomes adapted to low rates, asset prices price in cheap money, business models are built around cheap credit. Zombie companies that could not survive at normal interest rates persist because the cost of their debt is artificially low. This adaptation is not temporary, it is structural. The longer rates stay low, the more deeply the economy embeds itself in assumptions that low rates will continue. When the next shock arrives, the central bank faces a constraint it did not face before. Rates are already near zero. They cannot be cut much further. The balance sheet is already large. Each additional dollar of asset purchases has diminishing stimulative effect because the market has already priced in intervention. The toolkit has not been replenished, it has been drawn down. The margin of safety has been consumed by the last rescue. This is not a theory. The Bank for International Settlements, the central bank of central banks, based in Basel, Switzerland, has published research explicitly documenting this pattern. Their 2014 annual report warned, with unusual directness for an institution of that disposition, that global central banks were running out of room, that financial cycles were becoming more extreme, and that the recoveries being built on debt and asset price inflation were not durable. The warning was noted, cited in academic papers, and largely ignored by the policymakers who most needed to hear it. Global non-financial debt, the debt held by governments, corporations, and households outside the financial sector, stood at approximately $84 trillion in 2000. By 2008, it had risen to around $113 trillion. By 2023, it exceeded $235 trillion, according to data published by the Institute of International Finance. The debt did not double because the global economy doubled. It accumulated because each successive crisis was resolved by making borrowing easier, cheaper, and more available, and because the political incentive to defer the cost of adjustment is always stronger than the political incentive to absorb it in the present. Corporate debt in the United States tells a particularly pointed story. Non-financial corporate debt rose from approximately $4.9 trillion in 2008 to over $10 trillion by 2023. A significant portion of this debt was not raised to fund productive investment. It was raised to fund share buybacks, purchases of a company's own stock that increase earnings per share without increasing underlying business value because cheap money made borrowing for this purpose more attractive, then earning returns through operations. American companies repurchased over $5 trillion of their own shares between 2010 and 2019. The debt they issued to do it remains. The shares bought back are gone. Meanwhile, the federal government of the United States, which entered 2008 with a debt-to-GDP ratio of approximately 64%, ended 2023 at over 120%. Interest payments on the national debt exceeded $1 trillion annually for the first time in American history in 2023, surpassing the defense budget. The Congressional Budget Office projects that under current law, interest costs will consume an ever-growing share of federal revenue for decades, steadily crowding out every other form of government spending. The fiscal space that allowed Washington to pass a $787 billion stimulus in 2009 and a $2.2 trillion CARES Act in 2020 has been partially consumed. The next crisis will arrive with less of it available. It is 2025. Kevin is 60 years old. His 401k is larger than it has ever been, sitting at a number that still surprises him when he checks the statement. His mortgage is nearly paid off. On paper, he is fine. Better than fine. But there is something he notices now that he did not notice in 2009. The language around the economy has changed. The Federal Reserve spent most of 2022 and 2023 raising rates at a pace not seen since the 1980s, and even at their peak, rates were lower in real terms than they were before 2008. Getting back to what used to be called normal turned out to be something the system couldn't sustain without breaking things. Silicon Valley Bank broke. A handful of regional banks broke. The commercial real estate market began to crack quietly, with office vacancy rates in major American cities reaching levels not seen since the early 1990s, and the loans financing those buildings sitting on bank balance sheets at valuations that assumed offices would be full again. Kevin does not know exactly when the next crisis will arrive. Nobody does. But he is old enough now to notice that each time the economy wobbles, the people managing it look slightly more anxious than the last time, like engineers who keep finding new ways to keep an aging bridge open, and who have started avoiding eye contact when you ask them how much longer it has. This is historical and educational analysis. It is not financial or investment advice. Nothing here should be taken as a recommendation to buy, sell, or hold any asset. What history makes clear is the shape of the trap. A system rescued by debt cannot easily be deleveraged. A system adapted to near-zero rates cannot easily tolerate normal ones. A central bank that has expanded its balance sheet to $9 trillion cannot easily shrink it without removing the liquidity that markets have come to depend on. Every tool that has been used to prevent collapse has left the system slightly less capable of preventing the next one. The pattern is not hidden. It is in the BIS annual reports. It is in the Federal Reserve's own published data. It is in the CBO projections. It is in the corporate debt figures and the sovereign debt ratios and the commercial real estate vacancy rates. The information is public. The conclusions are uncomfortable. And the institutions responsible for managing the system have every incentive to tell you the bridge is fine. History Meets Economics exists to read the engineering reports, not the press releases. The pattern is already in motion. If that distinction matters to you, you know where the subscribe button is.